Talk is on, where you receive good information for your mortgage needs, such as mortgage programs and foreclosure programs to help get you out of foreclosure. Stay tuned and hear what's coming your way. Going wrong when my life's uncertain. There's no place I'd rather be. Standing up beside you, my man. Your love always comforts me. So thanks for being a friend. Over and over again. I can never repay. Love is sending my way, yeah. Something else I'm gonna tell you. And welcome to Mortgage Talk. How you doing out there? Everybody out there in Mortgage Talk land? Man, glad you guys are out there. Glad you guys are there. Oh, man, beautiful day. It's a good day here in Chicago, in the suburban part of Chicago, the Windy City. And we are glad to be here with you. I'm Rick Montgomery, and thank you for you being here today. And thank you for being a friend of Mortgage Talk and a friend of me for you being here on Mortgage Talk. Man, I feel good about this. Got some good information for you today, and I'm gonna share it with you. Give me 1 second. Let me get my paperwork together. Just give me 1 second. All right. I want to talk to you today about you. And what I mean by that is this is indeed related to your property, your family, yourself, protection for yourself. But it's about giving information that can bring about a better understanding of what you should be able to do to protect yourself, protect your family, who are your loved ones. COVID-19 has done quite a bit of damage. It's not someone that you don't know that has not been affected by COVID-19. Now, the vaccines are going out and is doing good for many times, many people. Some people have received some side effects from it and not so good. But overall, it is doing what it's supposed to be doing, and that's aiding us to try to reach some kind of level of normalcy. Okay, what is normalcy? You know, are we going to return back to what it was? Yeah, to a certain degree, but there's some changes in there because COVID-19 has indeed affected so many people until it's not going to be the same what we want it to be as the same normalcy that we once had before COVID-19. April the 1st, yesterday, opening day for baseball. The Cubs on the north side of Chicago got together, excited, man. The businesses in the area is excited because it brings people that will spend money for enjoyment with their friends and family, and also it helps the local business in the area too, for whatever the products and service that they are selling. One gentleman, he sell peanuts, and he's been doing it for over 31 years. And I know other cats out there that have done it too for the White Sox game on the south side of Chicago, off of 35th Street, off of the Dan Ryan, and those that have been doing it at the Bear Stadium and was doing it for the Stadium too, and even for Northwestern football. Wow, you know, so they have been in the business for a long time, but there have been so many people that has been affected by COVID-19 that was not prepared. Some because they didn't know, some because they did not understand, and some because, well, just to talk about and hear the word insurance seemed to have scared them. But I've been talking to quite a few people. I was at the library, which is still under the COVID-19 watch and protection, justifiably so. And I was there to pick up a book and also to talk to a friend. And we was talking about insurance. And I found that the conversation for those that were around, there's only a few, maybe one, two, three, and they stop and they start to listen. And I remember when I was talking about insurance, people would look at you and just walk away, you know. And the interest and the questions that came up. Now I was only supposed to be there just for a few seconds, really walk in. I knew a book that I wanted, grabbed the book that I wanted. It took less than, oh man, maybe 10 minutes after my turn to come in. And it wasn't crowded at all. No. And I had to get some documents notarized, okay? And I did that because I'm a notary myself, but I can't notarize my own documents. And so me and the notary got to talking, and that got the interest of the others that was standing around when we talked. I mean, walked into her office there, and they actually was standing by the door while we were talking, and that was quite strange. But we were talking about insurance, and questions came up, and I was answering the questions, and I'm very happy to answer the question, because anybody that is in the business, no matter what business that it is, if you enjoy doing what you are doing, then you enjoy talking about what you are doing or what you are doing. And that excitement and that enjoyment comes out when you are explaining and answering questions. And that's the opportunity that I had. And I say that because truly it is an opportunity. And that's the opportunity that I had when I was answering their questions. And they had some really good questions of concern. And that sparkled me to say, maybe we should do a show about this, because if there's a few from where you are, because there's a few from where I was, then there's many out there that may have the same questions, but it's looking for the answers. Since COVID-19, and so many people have passed away without insurance, without protection for themselves and for their family, and leaving their family in a bit of turmoil. And all that can be avoided. 11 million people is under unemployment. But yet, protection for yourself is affordable because insurance is tailored to the need of you and your family and your affordability to maintain it. So when I use the word protection, that's what insurance is. It is protection. And it gives you a peace of mind. And it also, not just for death benefit, but it's for the living, man. It's for your heirs. Insurance can create wealth and have done so centuries, way before COVID-19 and beyond COVID-19. But so many people don't understand that and don't know that. But that's what it does. So what I want to do today is talk about what not just specifically what the questions were actually asked, but to take the product that can fit the questions that was asked and share that with you, my Mortgage Talk listeners. That's why I say thank you so much for you taking your time out to tune in and to listen to Mortgage Talk. But thank you for being my friend. Thank you for being my Facebook friend. Thank you for being my Instagram friend and family. Thank you for being my Twitter friends and family and my LexIn friends and family. Because we're live through my social media just as well. And it's interesting that we're live and many people can see this. And I hope that many people, that even if you have your protection, that you will click on down there where you see those three dots, click that on and share this information with someone, because you just may be the light that they need. You just may have the answers to the questions that they have, or the solution to what they actually is looking for. Now, a lot of people don't just come out and just share with you what they're looking for. But when they hear the solution to what they're looking for, they go, wow, I didn't know that. So I want to talk to you today about that today. I want to talk about joint life insurance policy versus survival life insurance. Joint life insurance versus survival life insurance. Hang with me a little bit. Joint life insurance is when an insurance policy covers multiple people on one policy. Let me say it again. Joint life insurance policy is when an insurance policy that can cover multiple people on one policy. That's a savings. That means that each individual do not have to obtain each policy for each individual, which is separate premium for each individual, which is more money spent on premium for coverage. When you can have one policy that can do that. There are two options for joint life insurance. Option one, first to die. I will explain that later. Option two, survivorship life insurance, or second to die. The standard option for joint life insurance is often a first to die policy. In the first to die joint life insurance, if one of the insured, which is a spouse, dies, the death benefit becomes payable to the remaining spouse as the beneficiary. The objective is to leave money behind to the spouse to help them with their living expenses and to replace the loss of income from the death of the other spouse that could have been caused by COVID-19, as so many has been under that reason. It could be the cause of cancer. Whatever the reason for the departure of that spouse, they have a comfort zone to know that the lost income from that of the first to die partner will have a coverage, a protection for them. When there's two incomes and one income go away, it can become a very hard process. And sometimes a regular policy may not be enough for that, because of it could be many circumstances that a person may obtain a $15,000 face value policy, just enough to cover burial and nothing else. It could be a term policy, which leaves nothing but the amount of money of the face value to cover the cost, to cover the expense of death. Some will even have a whole life policy that will hold a cash value, but the cash value may not be enough to cover 6 months or 1 year. Well, I'm going to tell you about this policy because it's a great policy, but I want to give you more details on it. I'm not trying to sell it to you. I just want you to understand the procedures of this policy, giving you an opportunity to say, maybe that can be something I need to look into. So survivorship, joint life insurance versus survivorship life insurance. What is the difference? All right. Survivorship life insurance policy is also referred to as joint survival life insurance. Is also referred to as second to die life insurance or veritable survival insurance. Survival life insurance is often chosen when the purpose of the insurance is to leave money to the couple or to the inherited, which is why it only pays the death benefit when a spouse have died. The type of policy that the survival life is normally recognized under, it is recognized as a permanent life policy, such as a whole life policy that has a cash value built up, or a universal life insurance that has a stronger cash value built up. It is important to know that term life policy is less expensive, but is not normally used for survivorship. It does not last for life. It lasts for a certain term, whether it's a 5-year term, 10-year term, 20-year term, or 30-year term. Your independent insurance carriers, the insurance companies, will make that determination of whether they will offer that policy under term. And it's very, very, very rarely offered under term. And those are the two reasons why there is no cash value buildup and it's a set time frame. And maybe you may outlive that time frame. Okay? Because we don't know when the great I am will give us a call. So it's normally placed, survival life insurance and joint life insurance is normally placed under whole life policies because it has a cash buildup and other amenities under it. And also it has and lasts for life up until that particular time. Now, veritable survivorship life insurance, also known as survivorship life insurance, is a type of joint life insurance policy. This became a confusion to some people, and this is why I want to talk to you about it so we can try to diffuse that. Remember what I said earlier under joint life insurance, that it had two options. The first option under joint life insurance is that it is for the first to die. If one spouse dies, it will pay the policy that the second spouse will be the beneficiary for that policy. It would not only leave the face value that was chosen by both couples, and it really is used for couples, okay? But it's also used for your inheritance too, okay? So it will pay for the first, if the first spouse dies, it will pay for the second spouse. Survivorship life insurance, or the second to die life insurance, if you choose that, well, that policy will only pay for if both spouse dies, then it will leave it to the beneficiary. Under survival life insurance, as I mentioned earlier, it has three options. The options, again, as I will repeat: option one, joint survival life insurance; second to die life insurance, you can choose. These are what you can choose. And variableship insurance. So I want to explain what variable insurance is. Variable, survivorship life insurance, also known as survivorship life insurance, is a type of joint life insurance policy that insures two people, okay? Survivorship life insurance is often used by couples or spouses. Survival life insurance only pays the benefit to the beneficiary. When all the policy holders or insured people on the policy have died, it will not pay the death benefit if only one of the insured dies. Survivorship life insurance works differently. It is a joint life insurance policy, and it covers both people, but will only pay out when both insured people have died. Survival life insurance policy only covers both people, but will only pay out when both insured people have died. This is why it may be known as second to die. Both spouses die, the beneficiary will get paid under survival life insurance. The strategy in a survivorship life insurance policy is to leave behind money to your inheritance of the couple, as opposed to in joint life, first to die is known as insurance policy, that instead leaves the death benefit to the spouse. Now, there are some few key advantages to survival life insurance. Key number one, it preserves wealth as part of an estate plan. This policy is used for that. It preserves wealth as part of an estate plan. Many people have very little asset, and they don't have a large estate to leave to their inheritance. They want to leave them something, but they just don't have enough. to leave. So they will obtain a survivorship life insurance policy because it will leave the inherit operating funds to help them through this tough times and to meet some of the obligations that they will have. It can help them. And how it's done is that it can even help them up maybe a year, maybe 2 years, maybe 3 years, maybe 4 years. It all depends on how you structure it. It can even last longer than that, 10 years or more. So it helps put revenue funds in your estate when you don't hardly have any or you have none. And so, in other words, instead of leaving just the face value that you have, this policy has a cash buildup too. So you're going to not only leave the face value of your choice, but you're also going to have a cash built up value that they will get also receive funds from that policy also. Second key, this particular policy can create wealth for your inheritance. Third, getting insurance when one spouse is not easily insurable. When you have one spouse that's not easily insurable, this particular policy is a good one to obtain. Key number 4, assessing cash value when one spouse have died while still presenting a death benefit to the inheritor. You see, the cost of saving comes into play. You don't have to have 2 different policies. When one person have a difficult time of obtaining insurance, you can get them insured under survivorship life insurance. Summing this all up, how survivorship life insurance affect your estate planning. One important factor, estate planning aspect to a survivorship life insurance policy is that the benefit is not payable to spouse, but instead is payable to the inheritor. There are tax implications in this scenario. Many people use part of their life insurance death benefit to pay federal estate tax and other estate settlement costs. Life insurance is a good way to leave money to your inheritor, not only because of the death benefit, but the cash value that the policy generates, but because of tax advantages that you have with this policy, able it to grow, to grow, to grow, to grow. In other words, the money that you put into the policy that is taken from the premium is not, it generates an interest on top. You only tax the interest, not the investment that you put in. Okay. And death benefit policies, when the death benefit is paid out, is tax-free. An estate planner, attorney, or a financial planner can help provide you with guidance as to the best way to manage your estate and to do the estate planning that can be tailored to your specific needs, because everybody's circumstances is different. So when you're looking at a survivorship life insurance policy, you understand that it's really geared and set up to leave and build wealth for your inherit, so they will be able to move on and live comfortably in their life. It has a cash value and a benefit factor for you, the living, that if you happen to need any particular funds, you can borrow from your own cash value. And that's for the living just as well. But it's designed to do what I mentioned earlier, to build wealth for your inherit. Joint life insurance is designed that you can cover multiple people. You can even cover just a spouse, or if you happen to be a couple, it can cover that. And a joint life insurance option, as I mentioned earlier, is often a first to die, meaning that if one spouse passes away, the beneficiary is the second spouse. I want to leave money to my children. If something were to happen to me and my wife, and maybe she has a little difficult time in trying to obtain a policy for herself, well, then that joint life insurance policy could be one that I want to utilize. On the survivorship life insurance, if I'm a traveler and I like to travel and I have to go by plane, or I'm a worker and I'm working hard and the wife is working hard and doing COVID-19, anything could happen. We pray that nothing do, but anything can happen. I ran into someone that lost their mother and their father. Mom didn't have any insurance. Dad had just enough to take care of his funeral arrangement. The house that they lived in, they had to make a decision on what they're going to do because they could not afford to pay the mortgage. Their job that they had, they couldn't afford the mortgage, or lose their apartment or leave it and then say, I'm going to live in the house and try to pay the mortgage. They just couldn't with all the other obligations. And remember, one spouse did not have insurance. So they have to come together to try to bury one of their parents. But under survivorship life insurance, this survivorship life insurance that generates wealth was able to leave money to the inherit, that was able to not only cover the costs if they had had this policy, would have not only cover the costs for their loved ones, for their parents, but will also have generated wealth for them, and will have continued to generate that wealth too, by the way, that will enable them, if they need it all, to be able to get the face value, to cover the costs, to pay the mortgage. Maybe it all depends on how it is structured. It would have paid the mortgage off completely, depending upon the face value. But it also, from the cash reserve, would have left revenue funds, another source of bucket of income that would allow them to be able to continue their structure of living. And if they want to stay in the home that they grew up in with their parents, they have been able to do that. Or if they want to sell the home, now they have wealth on top of what was left for them, and they have a better chance in a tough economy with massive layoff to be able to stand firmly in their square. These two types of policies is one that will not fit all and will not fit all circumstances, but it certainly can be utilized if it meets your standard of need. This is just two different policies, but somehow they have a correlation with some of the benefit factors but some is a little bit different than the other. I wanted to share this with you because I want you to have options for protection for yourself. You hear me talk about, even if this does not work for you, it doesn't shut the door, because there's other policies out there that can work for you and affordable and tailored to your need, even though you are unemployed. Don't use or let unemployment become a deciding factor for you to say that you cannot afford it, because it is not true. A policy that would fit your need, maybe your need is just to have a death benefit policy. And that policy can just fit that need, which is a term policy. Maybe you're short from the policy that you have and you need a $5,000 add-on or a $10,000 face value to add on. Well, then you can obtain a term policy because the cost is very, very affordable, and you'll be able to meet that. You've heard the advertisement, and you heard the advertisement from various insurance companies. Some that say $9.99 a day. It doesn't fit everybody. And everybody's not going to pay $9.99. But there are some that will be able to pay that. And that's under a final expense policy. See, a final expense policy is a policy for people that are ages of 50 and older that ordinarily, based on their physical circumstances and age, a traditional whole life policy may be a little bit more than they want to attack. But having a final expense policy will give them a whole life policy, which is what final expense is, and it's affordable on the level of a term. Is affordable for them, enabling them to be able to have some type of coverage. If you're looking to roll over money into your policy, then you're looking at a whole life policy or a universal life policy or even an index universal life policy. You see, insurance policy, when you have these policies, your premium that you pay, a percentage of that premium goes into that cash reserve. Well, the interest of that cash reserve could be anywhere under whole life, 3.25%, 4%, 5.75%. Higher than what any bank will give you, which is 0.1% of your money that you have in the bank right now. I said 0.1%, not 1%. Big difference. Take the money that you have in the bank, multiply by 0.1%. That is the interest that you are accumulating on your money. Imagine that money being into your whole life insurance policy at 3.25%. Multiply that. That is the interest a month that you're earning on your money. Don't we want our money to grow? And under an insurance policy, because in the bank, FDIC gives them the protection up till $250,000. Anything over that, it's a loss to you. Even though you may have $500,000 in the bank is only going to cover $250,000. If you have $500,000 in your cash reserve policy, the protection of insurance, all of your initial investment is protected. And the interest incurred on top of that is yours. It's protected. When you have a policy like the index universal life policy that mimics the stock market, the growth of the stock market, the higher the interest is. On the index, you're talking interest that can be as high as 9, 11, 12, 14, 16, 18%. Now understand there's a cap with certain insurance carriers. They may cap it at 12.5, one carrier may do. The other may cap it at 15%. The other one may cap it at 11%. What do you mean by cap? Well, what I mean that if the interest is tallied up, because you earn interest per day equal up to that month of total interest, but it is an annual payment under index. So it adds up for 12 months, and that interest could be as high as 17, 18, 19%. If you have a cap with a particular carrier, let's say that your cap is at 15%, well, then your account will be credited 15% of your total value in your cash reserve. The rest, the insurance company will keep, and you want them to do that because you want them to make money, and they're going to be around for a long time. But you have the protection of that. And if the market falls, you lose none of your interest accrued, nor your investment in your protected policy. You can borrow money from your policy whenever you need it. So it's there for the living. So is universal life. The interest is just not as high as an index. So it's whole life. The interest just don't climb as high as a universal. These are the difference from a whole life policy than a term policy, which is one of the cheapest policies that you can obtain. You want insurance for what the benefit factor can do for you and your family. You don't just want to buy insurance because it's cheap and you cover none of the aspects that you need. You want insurance that's going to leave protection for your family. Gentlemen, ladies, if something were to happen to you, God forbid, and your insurance pays out, don't you want your insurance to be able to not only pay out to cover the funeral costs, but you want the insurance to also be able to leave some type of revenue funds for your inherit? That could be your husband, that could be your daughter, that could be your son, or it could be your sons, or it could be your daughter, which they are now and always have been a part of your estate. You want insurance to be able to leave something for them that they will have something to build on. It's been like that since insurance first came out in the 1700s. That's what insurance does. And if you're there and you don't have insurance, especially during a COVID-19 time, it's time for you to think. But don't just go out there and just grab any insurance. Don't just go out there and just get something, just say that you got something. You want insurance to be able to be tailored to your need, because you understand what your needs are, and that insurance policy can be tailored to your need and tailored to your ability to pay the premium. It is not, okay, this is your policy and this is what you're going to have to pay. Yep, that's what it is. It can be tailored to your need. It's not like you go to some car place and some car dealership and you get a high payment and they say, well, it's still within your DTI. It's still within your debt ratio. So you got to make certain adjustments. Maybe you won't get 2 cell phones. You get 1 cell phone. Maybe you will get rid of direct TV or something, but just keep it for about 2-3 years, and you can come back and then you can get a lower interest rate. No, that's not insurance. Insurance is not like buying a car. Okay, so take the concept out of your mind. That concept of buying a car, take that concept out, because that does not apply to insurance. Insurance is indeed tailored to your need. With the right insurance agent that sits with you, that understands your need, because he's your agent or she's your agent for life. They're there for you to call them anytime to ask any questions that is relating to your policy or anything that's related to the insurance industry to help bring about some clarity for you. People have their policy evaluated. If you currently have a policy, get your policy evaluated. I met a young lady, and my own father, who is not with me now, God bless his soul, in the 60s and in the 50s, they sold African Americans term policies. It was like they didn't even bother trying to offer them whole life. Term policy is a time limited policy. 5 years, 10 years, 15 years, 20 years, 30 years. And they sold them a 20-year policy, a 10-year policy. 10 years have passed. And this particular lady was still paying her premium. We're not able to get back that money for her because the policy had been expired. But she didn't know. She thought she still had coverage. So when she was talking to an agent that was talking to her and was saying, hey, let me evaluate. No, oh, no, I don't want that. No, I'm covered. Thank you. I'm covered. Thank you. Okay, I'm covered. My husband or my wife, we got this a long time back. So we're covered. But they didn't understand that they had a term policy and that the term time was up. Another client, the term time was up that year. On a particular month, on a particular date, it was up that year. Now, I forgot what month and date it was. So for this example, I'm going to say that it was April. It was up April the 1st. I'm going to use this as an example. On April the 1st, the policy comes to an end. She has no more coverage. But in her mind, she is viewing this policy as a whole life policy, and it's not. No one sat down to explain the difference. I was able to explain the difference from the policy that she had from the free evaluation to the policy that she would need. Now, it's her choice. If she wants to go with term again, she can. But now you have a better clarity of what term policy is and what it covers and what it does. You now have a clarity on whole life policy, on what it is and what it covers. And whole life is what the name of it says, is for the rest of your life. Everybody's circumstances changes. The older we get, we have found from going on YouTube, and I encourage you to do this, go on YouTube and look up 2020. You heard of them, 2020. And look up 2020 when they was covering the 401k. You're going to find millions, and I mean millions of people who have lost money in the 401k, that contribution plan. Because you see, you can't go in when the money is falling. You have to wait to the next enrollment date. And that could be 3 months down the road. Meanwhile, you're losing money. One of my fellow colleagues, one of my fellow police officers, Chicago, had $15,000 in his 401k. He'd already lost $5,000. He had 2 more months to go before he can go in and stop the bleeding. By that time, he was worried that he may not hardly have any money, but there's nothing he could do but sit there and watch and pray and hope that it goes back up. Now, you heard of the saying, hope in one hand, put waste in another hand, and see which one will fill up. You don't have to do that when you have a whole life policy. You have not only that protection, but you can go in there and change at any time you want. If you have a universal life policy, which is another whole life policy, and comes with universal, comes with different variables of what you can invest percentages of your cash that you have in that policy toward. For example, you can invest if it offers you a real estate, that you can invest into real estate. You can invest into the European market. You can invest into the Russell 2000. You can invest into the S&P 500. You can put 20% there, 25% there, another 25% over here. And you can put another 20 over there, equaling all up to 100%. And in 3 months' time, if you decide that you want to change because you will get a printout from your insurance company, and you see where the growth potential is higher on 2 of the choices that you're made, and you've seen that it's kind of stagnating on the other 2 choices that you made, then you can go and say, hey, take that 20% I have over here and put that into the Russell 2000. Take the other 20% or 10% and put that into the S&P 500. So you can go in and you can diversify at your leisure, at your will. You can't do that on a 401k. So it gives you better control of where you want your money to grow at. It gives you better protection because it's an insurance policy. It gives you a protection because your money is never in the market. It just mimics the market, leaving you with your original investment and the interest growth. And it's tax deferred. It's tax deferred. When you do decide, policy paid for, when you do decide that you want to pull your cash reserve out, I want to take my cash out, you're only going to be taxed. Your partner is Uncle Sam. Remember that. Uncle Sam is always going to be your tag team partner. Uncle Sam is only going to tax you on the interest accumulated, not the investment that went in. Protection for the policy. So you can decide which policy would fit you during this pandemic time. More people now have got it. And they understand, I need insurance protection. You need your policy evaluated? Then call my office, 708-572-7855. We will evaluate your policy. It doesn't cost you nothing. We're not trying to sell you anything. We'll evaluate your policy. If it's there, meets your need, you did it, congratulations, move on. That's it. That's it. There's no, well, I got something over here. I think we can. No. No. It's not that at all. It's not that at all. But if it's not meeting your need, then we would propose some policies that could be tailored to your need, explaining them to you and giving you the option to choose. So you don't have to be stuck, or you may not even have coverage and think you have coverage. You can get your policy evaluated. Look at the policy and I'm talking to my beautiful seniors, look at the policy that you obtained 20 years ago. Do you know what type of policy that it is? Is it a term policy? Was it a whole life policy? Was it a final expense policy that's under the umbrella of whole life? What type of policy was it? And is it meeting your needs? I want to leave some money to my daughter. Okay. What's the face value of your final expense policy? Oh, it's just enough to cover funeral costs. It's not going to leave much to your daughter, though. So that's not the right kind of policy. Okay. I want to leave money to my family. Okay. I want them to have money to cover my costs and leave money for them to survive with. What type of policy that you have? I have a term policy. Okay. What's the face value? Because that will determine whether you can leave money or not. Okay. Well, it's about 8,000. It's not even enough to cover funeral costs. Okay. Accidental policy. Be careful. Be careful. Accidental policy pays out based off accidents. Okay. It's not a whole life policy that's going to pay out in case something happens to you on a natural cause. You have to be involved in an accident that caused death in order for that policy to pay out. Some people under whole life policy will put a what's called a rider on their policy that is an accidental rider policy. So, for example, they have a $25,000 policy and they put a $5,000 accidental rider on there. If something happens to them by accident, whether the plane crash or they're in a car accident, okay, that policy will not only pay out the face value, but it's also going to pay an additional $5,000 or an additional $10,000, whichever you choose, and depending upon the carrier, is going to pay that on top of the death benefits. Understand, death benefit is tax-free. You don't pay no taxes on death benefit, okay? These are some of the options that you have under whole life policies. Term is the same way. You don't pay no taxes on that, on death benefit, okay? But a term policy, you can't borrow money when you need it because it's strictly just for death. Now, there are a few, very, 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 very few, that offers a cash value rider with a term policy, enabling you to obtain that because, whoa, I love the cost that I'm paying, man. It's really, really low. Lower than, I can pay that 3 times. And you can attach a cash value to it if you like, if that carrier offers it, okay? And not all do. So you can evaluate your circumstances. Everybody's circumstances change. Usually what? In 3 years, 5 years? People's circumstances change. The older we get, the wiser we get. And our circumstances change. We got a promotion. Our circumstances changes. So you want your policy to be able to meet your everyday operation because your circumstances have changed. So get your policy evaluated. If you don't have any policy, then get you one. You should not be without a policy. You should not be on your social media on a GoFund account when these insurance policies are very, very affordable. You may have ran into 1 or 2, God forbid, and you may have received some higher quotes. And oh my God, no. And so you think that I'm not going to worry about talking to anybody else because they're going to just tell me the same thing. No, 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 no. Sometimes you have to just shop around a little bit, okay? And don't be discouraged because you heard some, well, what? No, I don't want to pay that. You may have to shop around a little bit, okay? An insurance broker like myself will represent so many companies. So we're able to find you the right company, the right insurance carrier that's going to fit your need and be tailored to your need. An agent that works directly for an insurance company cannot shop you around. They can only offer you what their company, what that insurance carrier that they work for, what they have. And I'm not saying that they don't have anything that's going to work for you. That's not what I'm saying. But their particular policies doesn't work for everybody. There's going to be some people it's going to work for them beautifully. There's going to be some people, it's the wrong fit. Shoes on too tight. Oh, no, 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 my feet too big. So you may have to go find another policy. But with a broker, it saves you from going around the mulberry bush because they're going to be able to find for you the right insurance carrier that's going to meet your need, whether it's health insurance, whether it's life insurance, whether it's annuity. They're going to be able to find your need for you. And it's going to be able to meet your need. Be open-minded to that, and ask questions. There's no such thing as a dumb question. The dumbest question is the one that was never asked. Get the answers to your questions. I hope this has helped. This is what Mortgage Talk is all about, because there are insurance policies that you hear me talk about a lot. Mortgage protection insurance, especially if you're a homeowner. Condominium, you're a homeowner too. Mortgage protection insurance. Renters out there, get rental insurance. The landlord insurance do not cover you. I said this to to a few young ladies, and boy, it was almost like trying to crack a walnut with one hand. Sometimes you can do it. Sometimes you can't. So you need the other hand to kind of get it together. Couldn't tell him anything. Oh, no, you're wrong. His insurance covers me. Yes, it does. Oh, I know. My girlfriend heard it and blah, 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 blah. And no, it does not. It does not. It does not cover you. You are responsible for your own personal items in the place that you rent. To put your world in that place, you're covered to cover your world. His policy only covers the building. It doesn't cover what you lost in the fire, whether you caused it or not. Well, I'm suing. Good luck. Okay. So you need rental insurance if you are renting. And they're very inexpensive policies. How expensive is rental insurance, Rick? Whoa, $6.95. Whoa, $8. Whoa, $10.95 a month. Hell, I can pay that out in 1 year. That's how cheap rental insurance is. But it will cover a lot of your most expensive things you have, from your gold watch and your diamond rings and your fur coats and your Gucci bag for $1,200. Okay, it will cover it for you. You have to list these items now. Okay, you may even have to take pictures of the items and show receipts of what you actually paid for the item. You will get depreciation value if you had it for a length of time, but the value of it is still there from a wholesale standpoint, and insurance companies will cover it. Same way they do your automobile. They use the red book to cover automobile loss. Black book is used for trade-ins, not blue book. Black book. Blue book is used by lenders. I know it's sold to the public as if, you know, but it's used by lenders to determine value. 90% of all cars, used cars booked out for a lender is booked out under NADA, N-A-D-A book. That's the yellow book, not blue book. So blue book is used on some used vehicles because blue book may offer a higher price than what NADA would do through some carriers. Now, your finance manager is not going to tell you that, okay? I'm telling you that because I'm a former finance manager in the automobile industry. So I can tell you that. They're not going to tell you that. So imagine having a broker that has knowledge and that shares with his client so he can be able to tailor the right policy for his client. So that's what I want to talk to you about today, because of the wonderful conversation that I had at the library, and found that the few people that was there too did not have insurance. And they didn't understand. And I hope that I'm able to leave them with that understanding and be able to provide service for them if they choose to choose me. But at least I feel good when I left them with some information that they didn't have. Because every day is a learning experience on this planet and in this world. So I want to share that with you. Mortgage Talk will be back on Tuesday. We're going to be talking about title. And we're going to go into the various types of title coverage and the type of title. Why? Because we believe that an educated consumer is indeed the best customer. And that's what Mortgage Talk is committed to. We've been bit by the bug of the gift of giving, and we're going to continue to do so and to give you good information that you need to have and to make clarity on some questions that you may have. You can always email me at mortgagetalk1, the number one symbol, at gmail.com. That's mortgagetalk1, the number one symbol, at gmail.com. Ask me any questions that you want. It doesn't matter. Yes, I will spend Monday mornings. I usually spend like 4 hours just answering all my emails, and I get a lot. I get a lot of emails. So I go through the emails. I get emails from the show, and I get emails from my business. I'm an insurance agent. I own my own agency. And so I answer a lot of questions that people have. And I get phone calls too. And I talk to them. If you want to talk to me directly, you can call me directly to my office. It's 708-572-7855. 708-572-7855. We are licensed in Illinois and in Virginia. Okay. So we can service all of our Virginians and all of our Illinoisans. We can service you just as well. Okay. And if you seek me in a different state and you come to Illinois, I can service you there too. Okay. So answering the questions that you have, more than happy to do so. You can email me if you like text. And now be patient with me. I'm not a texter guy. I go through some texts, but I get so much emails. But if you want to text me, give me about 24, 48 hours, and I can get back with you on the text. And you can text me at 708-577-0328. That's 708-577-0328. Ask me questions about the mortgage industry. More than happy to answer it for you, whether it's commercial or residential. Ask me a question about the insurance industry. More than happy to answer those questions for you. Okay? God bless you so much. I thank you so much. And I thank you for being my friend. And I thank you for listening to Mortgage Talk. We'll see you Tuesday. This is HAMP TV, in which we're on Twitch TV just as well. Okay? You can listen to me on Blog Talk Radio, and on speaker.com. Well, I'll be on there today, probably within another hour. We'll be on Blog Talk Radio and speaker.com. I want to talk about joint life insurance versus survival life insurance on there too. I want to share the information with them too. God bless you so much. May He forever keep you, and may He still be the light beacon in your life. Because when you put your hand in God's hand, man, it's the best hand to be in, because you're number one and still smoking. God bless you so much. And thank you for listening to Mortgage Talk. God bless you.
I hope this information is something that you can use for your mortgage needs. Remember to tune in next week at the same time for more Mortgage Talk. God bless you.